The 15-minute chart is often called the professional's time frame because it sits exactly at the intersection of data speed and data integrity. Trading the YM strategy, it serves as the perfect anchor for two main reasons. Number one, it's fast enough to day trade, and number two, it's slow enough to show true direction. It's fast enough to day trade. Even though 15 minutes sounds like a long time, in the context of a 6.5 hour trading session, it gives you 26 distinct data points. It gives you intraday relevance. A 15-minute candle is fast enough to capture the momentum of a New York Open or a midday reversal. It allows you to enter and exit a trade within a single session while still catching a 100+ point move on the YM. Unlike a 1-minute chart where you have 60 seconds to think, the 15-minute chart gives you enough time to breathe, verify your rules, and check your 200 EMA, and look at the left side of the chart for any symmetrical areas that you may find of interest. It's slow enough to show true direction. This is where the 15-minute chart really shines for gold standard setups. It filters out whipsaws. On a 1-minute chart, a single large order can create a fake breakout that disappears 30 seconds later. On a 15-minute candle, that requires sustained buying or selling pressure. If a 15-minute candle closes very strongly with a shaved bottom, it means the market maintained that direction for a full quarter hour. And that is true conviction, not just a random tick. Okay, structural integrity. Support and resistance levels like your elbows or shoulders are far more respected on the 15-minute time frame. A back test on a 1-minute chart might just be a random fluctuation, but a back test on a 15-minute chart just might be a random fluctuation, but a back test that holds for a 15-minute close, now that is structural confirmation that institutions are defending. So, by using the 15-minute chart for your direction, you can tell what the market is really doing. Now, how about a strategy to use the 15-minute chart with? There is a specific confluence. MACD rollover, 1-minute 200 EMA rejection, and the 15-minute red close. You get these three things, and it's what we call a multi-time frame trap. When these three events happen simultaneously, you are seeing a perfect alignment of momentum, institutional structure, and trend confirmation. And here's why this setup is so high probability. The MACD rollover, number one. The MACD rollover. The MACD rollover signals a extreme momentum shift. It signals that the short-term buying pressure is officially peaked and is now being overtaken by selling pressure. And the weight of the move, a rollover on the 15-minute chart, carries significantly more weight than a 1-minute crossover. It means that the big ship is starting to turn around. It's not just a small ripple, it's a major wave. Okay? As we've discussed, the 1-minute 200 EMA is your line in the sand. Okay? The 1-minute 200 EMA is your line in the sand. Now this EMA, when it's rejected by a 15-minute candle, like it is right here. Let's take a look here. This is a 15-minute candle being rejected by the 1-minute EMA. And when that happens, it fails to close above, you're seeing real-time rejection. The 15-minute candle interacts with the EMA but can't break through it. When that happens, it confirms that the 200 EMA is acting as a ceiling. This is where your rule of two becomes incredibly powerful. Price isn't just near the EMA, it's actively failing to conquer it. Okay? A rule of two just means that price is under the 200 EMA and it's rejected by it and finishes red. Now, when that rule of two is confirmed with a red MACD, a falling MACD, you know that that rejection of the 15-minute candle by the 200 EMA, the 1 minute 200 EMA, is a triple threat entry. Okay? So the 15-minute candle closing red. That's the final seal of approval. Many times the 1 minute chart will show a fake breakdown only to rally back. However, if that 15-minute candle closes red after rejecting the 200 EMA, it proves that the sellers maintained control for the entire quarter hour. Now, the red close often creates an engulfing pattern or a strong shaved bottom characteristic you look for. It tells you that the trade is now in full downturn and get ready for the symmetrical move down. Okay. So, that is a example. I'm just giving you an example here of a 3-point system to locate a great short. Okay, number one, let's talk about it one more time here. We have a MACD rollover. Okay, if you use this particular MACD right here, it's called MACD bands. We'll go to about this script. MACD bands, multi-time frame, TradeMaster Lite. That's the name that you'll find it on in the indicator section of the trading view. Okay, so you'll get a red dot when you have a full cross and when you have a rollover. So that happened here at 145. It happened way up here. Okay, as a matter of fact, there is another entry here at just past 145 as price is breaking out of consolidation. It falls under the 1 minute 200 and then back tests it with a couple of green candles. Don't get faked out by this spike up. Once it is rejected fully by the 200 and closes red, that is your short signal entry. You can enter a short position here with a stop under the most recent swing high up here. And you can take that down all the way down until we start to get a MACD that is beginning to curl back up again. Here it flattens, here it curls up. So you can get out anywhere in this zone here, giving you a trade that is paying you 5 to 1. Okay? The next entry for this short would be after the MACD rolls over again. Okay? Because here it's pointing up. You don't really, it might be red, but it's pointing up. You don't want it until there is a roll over of the MACD and you have a rejection of the 1 minute 200 by a 15-minute candle that closes red. That is happening here, right? This one doesn't count because MACD is still pointing, it's not pointing down. Here it's flat here. Technically it's pointing up. If you zoomed in enough, you'd see that this was actually pointing up, but without zooming in, you can see that it's not rolled over, it's just flat. Okay, here you can see, yes, MACD is definitely pointing down. There's no question about that. If you zoom in, you can see it's been coming down since this candle here 30 minutes prior, that started 30 minutes prior. But this candle, as it rejects the 1 minute 200 and closes red, is in concert with a MACD that is pointing down. Okay, that's your next entry. Okay, and look how well this one does. Let's take a quick look, measure it. Here's your entry. Why isn't that showing up? Here we go. Swing high, here's the stop, 69 points on the YM, and you can take it down until price starts bouncing back up again, which really doesn't happen until way down here. However, this candle is the New York Open. you may want to close the trade out before the New York Open. So this one gets you about 1.5. Still not bad. Not as good as this one with the tight stop, but still not too bad at all. Okay? So those are the three things you're looking for with a 15-minute candle, a 1 minute 200 as the rejection area, and a MACD that's pointing down. Okay? That's your setup.